Welcome to the Deep Dive, the show that extracts the essential knowledge from, well, the data fire host, giving you the shortcut to being well-informed. This week, we are focused on some really intense turbulence in the cryptocurrency space, specifically Bitcoin, after a recent period of pretty significant price decline.
Yeah, that's putting it mildly.
Right. The anchor point for this deep dive is a tough one. Bitcoin recently dropped below that critical psychological threshold of $90,000, hitting a painful low of, what was it, 89,550 just a few days ago.
Exactly. And that kind of sharp move, it sends shockwaves through the market and, fear becomes the dominant currency.
But our sources, and we have a whole stack of on-chain analytics and expert commentary, they reveal something truly fascinating about human behavior in a crash. We're watching the classic asset transfer event play out in real time. You've got the small players who panic and sell, and then you have the largest, most strategic players who are aggressively buying.
And we've got two key groups in focus here. The retail investors, which we're defining as wallets holding, say, 1 Bitcoin or more.
Okay.
And then the legendary Bitcoin whales, these are the entities holding over 1,000 BTC.
Okay, let's unpack this.
Our objective today is to use the specific data from platforms like Glassnode and couple that with analysis from firms like 10x Research and Bitwise to really dissect this market paradox.
So we're not just looking at the price.
Not at all. We're looking at the conviction behind the trades. Our mission is to understand the psychological blueprint of the whale, what allows them to accumulate assets precisely when fear is at its absolute peak.
And what lessons that holds for you, the long-term investor.
Exactly. We are aiming to move past the chaos and really define the underlying strategy.
And the strategy is just laid bare when you compare what these two groups did over that period leading up to the low. I mean, the inverse correlation is almost too perfect to believe.
It speaks volumes, doesn't it, about emotional investing versus, strategic investing. Let's quantify the panic.
Yeah.
The small investor group, those holding 1 Bitcoin or more, they were clearly capitulating. Glassnode data shows the total number of these smaller wallets dropped from 980,577 on October 27.
Okay, so just under 1 million.
Right, and it dropped down to a yearly low of 977,420 by November 17th.
That's over 3,000 small wallets that just disappeared from the count in, what, 3 weeks? It strongly suggests these investors sold their positions, probably taking losses, just to stop the emotional pain of watching that price drop further.
They became the market's liquidity.
They did.
And that liquidity, it went straight to the patient giants. While 3,000 of these smaller accounts were closing out of fear, the number of wallets holding over 1,000 BTC, the whales, was moving in the exact opposite direction.
Okay, let's focus on that movement, because the numbers here, they seem subtle, but they carry this immense economic weight. So when the price was hovering higher, around $114,000 in late October,
Yeah.
the number of whale wallets was actually at a low. It was the 1,354. They seemed, cautious.
Cautious until opportunity knocked. Once the market tumbled and that panic really set in, that count surged. By the time the price bottomed out on Monday, the number of whale wallets jumped to 1,384.
So that's a 2.2% increase in the number of whale addresses. It represents the emergence, or maybe the return, of 30 new whale wallets in just a few short weeks.
And that comparison is everything.
When you look at it, 3,000 smaller accounts sold out and 30 enormous accounts bought in. It really brings the economic leverage disparity into sharp focus.
Absolutely. Think about the average balance difference there. 3,000 retail positions, even if every single one of them holds exactly 1 Bitcoin, they're so easily absorbed by 30 wallets that each hold over 1,000 Bitcoin.
It's not even a fair fight.
It's not. What we are seeing isn't just a market principle, it's an operational reality. The financially resilient players who have the capital and, the mandate to look 5 to 10 years ahead,
Right.
they view these sharp sell-offs as clearance sales. While the emotion-driven, less resilient players, they're the ones providing the cheap inventory.
So the data paints this picture of emotional despair on one side.
It does.
And to measure that precise feeling of panic, the thing that drove those 3,000 accounts to sell, we have to turn to the Crypto Fear and Greed Index.
And what a number we saw. The recent index score clocked in at 11 out of 100.
11.
For an audience like ours, the implication is immediate. 11 is deep into the extremely fearful zone. This isn't just mild anxiety. This reflects mass capitulation. It's driven by pain avoidance.
And that's the emotional climate in which those 30 whales decided, yep, now's the time.
Time to execute. Exactly.
Okay, so here's where it gets really interesting. Understanding the internal market driver for this level of fear is I think, crucial. Marcus Thielen, he's a leading expert at 10X Research.
Right.
He pointed directly to the October 29th FOMC meeting, so the U.S. Federal Reserve meeting, as the catalyst that completely broke the fragile balance between market confidence and market fear.
And to get into the mechanism of that trigger, the Fed's messaging was just far more hawkish than the market was expecting.
Everyone was hoping for a pivot.
Everyone was hoping for language signaling a pause, maybe an early pivot toward rate cuts, something that would have been bullish for risk assets like crypto. Instead, the Fed really emphasized this stronger than expected commitment to keeping rates high for longer.
Citing inflation and employment numbers.
Exactly. Persistent inflation, robust employment. So the institutional money, which is incredibly sensitive to these macro signals, read that as a clear sign that liquidity was going to remain tight.
So they had to de-risk.
Many had to de-risk, which pushed the price down below $90,000. And that then triggered the panic selling among the smaller investors who were watching the price, not the Fed's transcripts.
Right, they're reacting to the effect, not the cause.
Precisely. But Thielen introduced this crucial layer of nuance, revealing that the whale community itself was internally conflicted. This complicates the simple, whales buy everything narrative.
Oh, okay.
He described an internal battle happening, a fascinating clash of motivations.
Tell us more about this whale versus whale dynamic. Who was winning and why?
Well, Thielen suggested that some of the OG whales, we're talking the truly ancient, super large holders who have between 1,000 to 10,000 BTC, they were actively selling.
Selling, why?
These holders are often very sensitive to macro conditions, and they likely decided to take some profits off the table, de-risking in light of that hawkish Fed stance.
So the veterans were using the opportunity to lighten their load at what was still a pretty high price before a potential deeper drop.
Exactly. But they were met with an aggressive counterparty. The slightly younger cohort of large investors, so holding between 100 to 1,000 BTC, they were the active buyers.
Ah, so a different class of whale.
A different class. Their motivation seems to be less about immediate macro trading and more about long-term positioning. They're seeing the price drop as maybe the last chance to accumulate large positions before structural institutional adoption really accelerates.
So they're playing a different clock.
Completely different clock.
Yep.
You have old money reacting to global economics and new money reacting to structural adoption timelines. That distinction is key.
Okay, so even with this clear accumulation by the aggressive buyers, Thielen still noted that the total net flow, and that means all transactions across all whale groups combined over the preceding 30 days, still showed decisive net selling.
And that is the crucial context. That's what explains the price dip below $90,000. Even though 30 new whales popped up, the aggregated selling volume from the OG holders and that initial retail panic,
It just outweighed everything else.
it outweighed the buying volume for a sustained period, and that pushed the market into that extremely fearful state, that index score of 11. It takes serious, sustained buying pressure to reverse that kind of momentum.
It truly was the perfect storm. You had institutional de-risking, macro pressure from the Fed, and emotional retail capitulation all at once. But let's transition now, because while the net flow data explains that short-term price drop, the long-term conviction seems to remain really strong among industry leaders who see this whole episode not as a disaster, but as a gift.
Yeah, the bullish counter-narrative is extremely loud among those who are focused on the long-term fundamentals. You heard Matt Hugin, the CIO of Bitwise Asset Management, state publicly that this current price level is actually a generational buying opportunity for long-term investors.
A generational opportunity.
That's his phrase. He's operating on the conviction that the market is close to bottoming out.
And his use of the canary in the coal mine analogy, I found that really compelling. Bitcoin, he argues, is the most sensitive and liquid risk asset.
Right.
Its sharp volatility, its early price collapse, it acts as a leading indicator, signaling potential risks in other asset classes, like stocks, before those traditional markets even fully react.
It's an early warning system.
Exactly.
And the signal in this case is that, yeah, extreme volatility is high, but that same volatility, when you view it over a 5-year horizon, often lays the groundwork for tremendous value acquisition. It just reinforces the whale mindset. If you believe in the long-term value, you almost welcome the temporary pain.
And we've seen some really high conviction statements backing this up. I mean, Cameron Winklevoss, the co-founder of Gemini, he posted a bold claim on X suggesting this is the last time you can buy Bitcoin below $90,000.
And that kind of confidence is also supported by technical analysis. Analysts like the Crypto Dog projected a swift recovery based on key technical levels.
How so?
They observed that the $87,700 price point, which had acted as this stubborn resistance before a major rally back in May, could now serve as a critical support floor.
So what was a ceiling is now a floor.
Potentially, yeah. And that could generate a strong bounce. It's exactly the kind of technical metric a conviction buyer would rely on to pull the trigger.
So what does this all mean? For you, the investor, watching this massive wealth transfer happen in real time, we've seen the data. 3,000 small accounts selling into an Index 11 fear.
Providing liquidity to 30 new aggressive whale accounts.
Right, and we've dissected the macro catalyst, the FOMC, and the motivations behind that internal whale battle, the OG selling versus the new buying.
The most important synthesis here, I think, is translating that clear psychological difference between a fearful seller and a strategic buyer, what we're calling the whale mindset, into actionable principles. This isn't generic advice. It's about using the data we just reviewed to inform your own strategy.
That clarity of purpose is essential.
It is. The first actionable insight is, anchor your conviction to measurable data. Whales aren't buying based on hope. They're buying because a certain metric has hit an extreme level that indicates value to them. So if you're a long-term investor, your conviction shouldn't be shaken by price noise. It should be dependent on the fundamental drivers. For instance, is that net flow metric starting to show more consistent accumulation, or are new whale addresses continuing to appear?
So you're saying instead of looking at the price chart, we should focus on the underlying health and the ownership structure of the asset.
Which is exactly what Glassnode was showing us.
Yeah.
Exactly. These are the signals of sustained confidence that matter far more than the daily closing price. The second insight is, understand your liquidity role.
Yeah.
Every time you panic sell, you are fulfilling a strategic need for a more patient, more financially resilient party. You are becoming the liquidity that fuels their accumulation.
Ooh.
The key lesson here is not buy everything now, but it's do not voluntarily sell low in a panic. Your decisions have to be governed by a premeditated plan, a set of non-emotional rules, not by the current extreme fear and greed index score.
That's a tough lesson for those 3,000 wallets this week. They basically traded patience for pain avoidance.
They did.
Yeah.
And that brings us to the third point. Patience is economic leverage. Whales know the market moves down by the elevator and up by the stairs. They have the financial resilience to wait out that elevator drop.
Right.
By staying firm, you're adopting that same discipline. If your belief in the asset's core value, its scarcity, its technology, its adoption trajectory, if that remains sound, then volatility is simply a feature of the market, not a reason to deviate from your long-term plan.
Adopt the patience of the 30 whales, not the fear of the 3,000 small investors.
That's the takeaway.
This deep dive has really underscored a core truth of financial markets, hasn't it? They are fundamentally a mechanism for transferring wealth from the impatient to the patient. We may not command the thousands of Bitcoin necessary to move the market, but we now have the analytical framework and the blueprint to adopt the patience and discipline of a whale.
And that discipline requires maintaining skepticism even when the headlines are terrifying.
Oh.
So here's a final thought. Given that internal whale battle that 10x research revealed, where OG holders were selling while a younger cohort was aggressively buying, you have two conflicting signals from the smart money.
Right.
As a committed, research-based long-term investor, which specific measurable data point would you rely on most heavily to confirm that the bottom is truly in? Would it be the total net flow metric, which still shows selling? Or would it be the increasing concentration of new whale addresses, which showed accumulation? Use the data to challenge the headlines.